Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Brent Donnelly, president of Spectra Markets and an experienced currency, equity, and futures trader, and author of two books on trading, which are Alpha Trader and The Art of Currency Trading. So, Brent, thanks for joining the podcast today.
Hey, good to see you.
Awesome. So, sorry for keeping the first question very broad, but, I'm very interested in hearing your opinion about the key macro trends that you're currently watching in the markets. And I guess, in your opinion, why you're watching them and where you feel they're going to go.
Sure. So I guess the big question is whether the dollar's turned. So as of right now, we had this really good dollar trend pretty much all year, tightening financial conditions, bonds down, stocks down, dollar up. And that was a pretty clear trend until around September. And then, some of the big drivers of that trend were kind of fizzling a bit, like the EU energy crisis. Energy prices came off a lot. People were ignoring it for a while, but eventually, fundamentals do matter at some point. And then we had also the fiscal crisis in the UK at the same time, and that was somewhat resolved by a change of leadership. So, and then you had the weak CPI, and now you have the Fed kind of eyeing up the landing zone somewhere around 5% terminal. So you have a lot of things have changed. And so those are all arguments for less dollar strength, but I'm not sure there's really like a great argument for dollar weakness now. And so the real question now going into 2023 is whether we get a recession or not. So like there's so many things pointing to recession, but then it's just such a weird cycle this time that it's tough to say. The biggest thing is in the US is that usually you get like housing and autos go, and then that's kind of like the underbelly of the economy, and then employment starts to turn, and then the shit hits the fan. But in this case, you have such a shortage of workers from the COVID cycle that like normally you go into sort of these conditions of like declining housing and things like that with the last two recessions. 4 million job openings kind of was in 01 and 08, and now there's 10 million job openings. And you can question like the methodology and whether like there's more jobs in the internet now or whatever, but I mean we're looking at 2008. The internet was well established by that point. So it's a strange setup where you have a lot of big loud like red light bells ringing for recession, but then you have a backlog of hiring. That means like the labor market could stay strong for longer than people think. So usually labor market lags, and so you can kind of ignore it because really like unemployment's always low when recession starts. It's just the way that it works because it's lagging. But this time it could be that the labor market's actually just very strong and stays strong. And it's hard to get a recession when like government spending's coming back, healthcare spending's coming back, services are strong, and the labor market's strong. So there's a lot of headlines about technology layoffs and all that, but like technology is a tiny percent of the US workforce. So the real question, I guess, and then today's PMIs were really bad. So the question is, can we get a recession, or like, will we get a recession, or is this going to be some kind of weird muddle through? But the yield curve's 8 for 8 in calling recessions. So, I mean, it's hard to bet against recession, but what I think is going to happen is just the timing is going to be longer. And so we'll get the recession, but I don't really feel like it's all that tradable yet. I'm kind of waiting for more signs of labor market weakness. Today we actually got a weak claims figure, like stronger, like higher claims, which is weak jobs. But I don't know. I think we have to see. But if there's a recession trade, I feel like even though people are very sympathetic to the idea of recession, I don't think people are positioned for it. So I think that could be a really, really big trade. So that's the most interesting trade on the horizon. But for now, I'm kind of in this consolidation mode where I think the dollar kind of overshot. We got way too excited about, like, people were literally saying like Germany's going to shut down because there won't be any energy. And then, that's not happening. So now I feel like we're in this consolidation phase. And then really it's just going to be the data that determines it. And one last thing on macro that's makes it even more confusing is that generally everyone agrees that the momentum of inflation has turned, like, and we're going to enter some period where inflation will go down. So it's really hard to do anything that's like pro inflation when the momentum is down, because even if you think it's going to be sticky and we're going to bottom at 4%, well, still that path from 7 to 4 is going to feel good, even if it's actually not great, because we end up, having a new floor at 4%. So I think it's going to be very hard to be like long dollars, short stocks for the next little while, just because the momentum of inflation is going the right way. And it was such a momentum trade on the way up that it's going to be hard for people to fight it on the way down. And the funny thing is, so CPI in February of this year was 7.7, and this month it was 7.7. But the reactions are completely polar opposite, because one was on the way up and now this one's on the way down. So we'll see.
Yeah, I remember. I can't remember which month it was, but there was sort of like a small decline, and I think we saw a similar reaction. Everyone was like, "Oh, yes, the Fed are gonna gonna pivot," and then it sort of went back, continuing.
Yeah. So
Yeah,
people love the Fed, like, is going to capitulate trade, because we've seen it so many times. But to me, that's people are a little bit stuck in the old framework of 2010 to 2020 was all about secular stagnation, mean reversion, low economic volatility, like nothing really happening. And certainly I don't think we're in that kind of regime anymore. We're in more like high economic volatility and potentially sticky inflation. And the other thing is, as like a government bureaucrat, which is what the Fed is like a government organization essentially, you're always going to take like the path of least regret, or like the way that you're going to look the least stupid. So, if they had trouble getting inflation up, they're going to work super hard and they're going to keep pounding and pounding. They were doing average inflation targeting and all that at the worst possible time. Now that inflation's high and they've been getting yelled at for that, I think they're gonna stay tight for too long for the first time in my lifetime, I guess. Simply because it's always about fighting the last war, and the war now is against inflation. So I don't see anything like a Fed pivot until we get like really bad data in the US.
yeah, and I guess from their perspective, they can just say, "Oh, we told you what we're going to do, but you just didn't listen to us."
Yeah. And people don't believe them, but I mean, I guess it's fair to not believe them, since they don't really stick to their word. I feel like it's a lot more useful to look at the economy and to look at the data and to look at what market yields are doing, and less to like, people spend a lot of time going through what every like tidbit that the Fed says, and it can matter at times. Like there was a unique situation in 2021 where they weren't capitulating because they were waiting for Powell to get renominated. So it did matter at that time what they said, because the second they dropped transitory, then all hell broke loose. But in this case, I don't think what they say is that important. I think it's more about the data, and if the data gives them an opening, I mean, no one understands what's driving inflation these days. So, sure, inflation could go anywhere. If inflation goes back to 2%, they'll be cutting, but I don't see it.
Yeah. So before you were saying you think, I guess in the short term at least, which is relative, but you would see that maybe there's a bit of a retreat or pullback from dollar strength, and maybe a reversion of sort of negative stock insights. Is that correct?
Yeah, I mean, that's what we're seeing. The thing is, though, like, that's been going on for a while. So in the end, to me, it's going to come down to the data. But yeah, the setup was so bearish, and positioning and sentiment and everything was so bearish, and people were bracing for really bad earnings too. And like, I mean, I could list 10 of them, but like Home Depot, Walmart, John Deere, those are like major companies that sell a lot of stuff in the United States. And most of them, like Target was an exception, but most of them are reporting decent earnings. And even like, if you talk about an economy that's where housing is collapsing, things like Home Depot shouldn't be doing well, and Home Depot's still doing well. So I think it kind of shows that part of what's going on in housing and autos is just mean reversion, right? Like, we went to crazy levels, and now we're coming back off of those crazy levels, but it doesn't necessarily mean that like economic activity is grinding to a halt. It's just more like it's rotating out of those areas which were massively overheated into areas that were cool, like like all kinds of services. And healthcare and government's actually a pretty massive part of the economy that it's boring to talk about, so you don't hear very much about it. But like, if you look at what government and healthcare is doing during COVID, nobody really got healthcare other than COVID, which was obviously a massive thing. But many people like delayed elective surgeries and delayed anything that you could delay, you basically did. So now like that backlog's getting filled the same way as like travel backlogs are getting filled. And then so there's a lot of rotation, but it's not completely obvious that all hell is breaking loose. And then, like I said, coming off very apocalyptic sentiment and positioning, that we could get a pretty wicked retracement. I'm not really all that all that bullish overall. In fact, I'm not bullish at all, because I think that eventually, once this squeeze is over, the impact of rates going up this fast is not really being felt yet, and it will be felt. So like, if you look at a chart of US 2-year yields going back to like whatever, say 1980, people are going to look at 2022 and go like, whoa, what happened there? That was pretty crazy. Like, it's a huge move, mortgage rates and everything. It's just that the impact doesn't happen right away, because debt that is not all like variable rate that just moves the day that rates move, right? So now when companies like, say, Carvana is kind of the poster child, when those companies start to try to roll their debt, or MicroStrategy is a weird example, but another example, when those companies start to try to roll their debt, it's going to be problematic, because they were borrowing when rates were 0 and they were borrowing at 4, and now rates are 4, they're borrowing at 10 or something like that. So, but that stuff takes a while to hit. And then where it's really going to hit is in mortgage holders in countries that use a lot of variable rate mortgages, which is almost all the countries, like all the G10 countries except for the US, because in the US it's government subsidized 30 years, like the most common. But in like Australia and Canada and stuff, there's much more, like, it's not exactly variable rate, because a lot of it's like 3-year locked and then variable. But if the housing bubble in Canada was like 2020 and 2021, then you got 2023, 2024, somewhere in there, like Q3 of next year, you're going to hit a cliff where a lot of people are starting to have to refinance at like crazy levels. There's a guy I work with whose mortgage payment's £1,500 and it's going to £5,500. He's not an outlier. It's just, I mean, rates were essentially 0 and now they're not. So I think going forward, I think there will be a lot of pain in 2023. And the sort of like bullish stuff that I'm talking about is more like, a multi-week thing maybe, but nothing really other than just a tradable bounce.
Yeah, and I guess those countries you mentioned there, they've probably got some of the hottest markets as well, like Toronto, London, Sydney. So I guess
Yeah.
that makes it even worse.
Yeah. And the crazy thing with those markets is they never delevered, right? So in 08, everyone, like, if you couldn't afford your house, you just went bankrupt, or you gave back the keys in the US, you didn't have to go bankrupt. So if you look at charts of like housing prices or housing leverage, like in the US and Canada, they're both getting pretty crazy in 08. And then 08 took it way down in the US, and then Canada's like going way up off the top of the screen. So what ended up happening is, so first of all, the consumers are way more stretched and susceptible to resets, but also like residential fixed investment, or just like housing in general, has become a massive part of the Canadian economy. It's like 10% versus like 4.7 in the US. And 10% is a lot. Like, so, and then you have all the ancillary stuff like real estate agents and, hardware stores and all the things that benefit from housing. So I am very bearish Canada specifically for 2023. And then especially if you look at like the currency, or you can like however people want to play it, it doesn't matter. But if you look at the currency, if you think about what has happened in the last like 18 months with the war in Ukraine and all that stuff, you had like the strongest possible economy, oil ripping, and the Canadian dollar never really rallied. So like you had the ultimate conditions for a rally in the Canadian dollar, and dollar Canada's at 133.60, which is like the high end of the range, i.e. strong dollar. So to me, that's like, normally I trade much more short term, but that's like a bigger picture example of good news, bad price, where you get like, a company reports good earnings and the stock goes down to me, that's like a good tradable signal much of the time, because like the thing's just not doing what it should. And that reveals either like medium and long-term people are fading it, or there's something broken in the like in the structure of that asset that, there's like a persistent seller or whatever. So to me, it probably reflects like long-term decline in competitiveness in Canada and massive debt increase that is fine. So like the crazy thing about all this like MMT and all the sort of free money and decoupling of revenue from taxes, like it used to be when bills came out in the US, people would say like, how are we going to pay for it? And they don't even ask the question now. Like everyone just laughs if you ask that. So the thing is like, that's all fun and games when rates are zero. So you look at like the pushback to like, the debt, like panic was always that, well, cost of servicing's flat. Because if you quadruple the debt and rates go from 5 to 1, you're just paying the same interest, so that it's sustainable, right? But then when rates go to wherever they are now in whatever country you're talking about, then the cost of servicing starts to become a real major issue. And that you can apply that to sovereigns, you can apply that to businesses, and you can apply that to consumers. All of them are going to start resetting, and none of that is good.
Do you feel like that could be a risk then, I guess, in 2023? Because as you mentioned, Canada is very highly levered privately and publicly. Australia,
Yeah,
Europe as
yeah,
well, I guess, more privately, more publicly. But yeah,
yeah. I mean, each place kind of it's interesting because each place kind of has its own story or drag. Like the EU's energy, the UK was like, there's still a bit of Brexit, I guess, and then the EU energy stuff bleeds over. And then you did have the fiscal, it's sort of like a stagflation story. And then in Canada, it's more just about like massive debt levels and low levels of productivity on like marginal spending. So I like owning Canadian bonds, for example, I think is a really good trade. It's like a simple trade. I just don't think rates can go up much more. You see the amount of inversion in the curves is basically generally the market saying when the central banks are getting tight, and tight central bank in Canada means a lot of bad, a lot of bad for 2023.
yeah, it's concerning to think. So I guess in terms of if we go back to the US, what would be the key data points you'd be watching to see if we're going to potentially see that recession, or maybe they're going to land the plane and we'll be all okay?
Yeah. So the thing that's important when watching data is like to understand, like, is it timely and is it accurate? And a lot of the data just isn't. Like, so we spend so much time like trading non-farm payrolls and that. Usually the standard deviation of the miss is like, can be almost as big as the number. Now the numbers have been bigger, but like when you get an NFP of 125, which is the old normal, and the standard deviation is 75,000 on a number that's 125,000, it's just like a random number, right? If you look at a chart of it, it's like and then there's revisions, there's like birth death model, which can change it by like 300,000. There's all these things that go into it, and it's lagging. So if you overlay like initial claims against unemployment rate, claims moves usually like almost a year before the unemployment rate. There's just like by the nature of the way numbers are measured and stuff, is some of them just lag a lot. So I think claims is the best. The soft data is timely and usually accurate. So like things like ISM and that are timely. They come out like, 2 weeks after the survey. The only one issue with the survey data is that, so there's soft data and hard data, and the soft data is like surveys and like how are people feeling, basically anything that involves a survey. And then hard data is like real on the ground industrial production, retail sales, and all that. And almost always the soft data leads, but not every single time. And the funny thing right now is that the soft survey data, I think some of it is just because of inflation. So if prices are going up, you feel bad, but retail sales will still be going up because retail sales are nominal. So if prices go up 7%, guess what? Retail sales should go up 7% this year. It's because it's the same, they're nominal. So I think some of the pain you see in the surveys is just people feeling bad about everything because prices are going up so much and their worker costs are going up and all that. but it doesn't necessarily mean that like economic activity is slowing the way it normally means. Like normally it means economic activity is slowing, because there never was any inflation to worry about in most of pretty much my whole life. So I'm like, I still think that the hard data will catch up to the soft data, but I want to leave an opening just to be open-minded, because it's possible that with this much inflation, the soft data is not going to truly reflect the hard data. So I think to answer your question clearly, I think U.S. claims is the best number. It comes out every week. It's pretty accurate. The revisions are small, and it leads at least it leads the labor market. And right now, I think the labor market's probably the most important thing. So, and then CPI matters, because like we know inflation's slowing, but maybe it's slowing faster than we thought, or maybe like you said that in that other time, whenever that was, May or something, you think it's slowing, but like that's definitely the dominant narrative now, is like everyone's assuming that. So if it's not, then that's a huge problem. So I would say CPI and claims are the two things to me that matter the most. Although like today's PMIs are pretty alarming.
Yeah, definitely. It's really interesting. So, is there any sort of time in history that you'd compare the current market to? Sort of, yeah.
Poof. So yeah, it's funny because the similarities in a lot of things to '01 are very significant. Like the whole bubble, the dot-com bubble and the crypto bubble were like, I mean, people were even using the same words in the two bubbles. It was insane how similar they were. And then the unwind is similar, like the tech layoffs, the sort of like the whole pace of it. And then the dollar was very strong in that period. There's a lot of similarities. I don't feel like it's very much like '08. That was more of like a leverage and financial crisis story. This is more like a normal like economic boom followed by bust type of story. And then with like a spec bubble on top of it, like '01. But then the thing is in '01, you can kind of use it as an analogy because a lot of things were similar. And actually inflation was kind of high relatively for that period. And inflation did stay sticky into the recession in '01. But like you really can't totally compare because inflation at 8% or 7% is just nothing like 2.5, 3. So I would say it's like a tiny, like a dash of the '70s, but mostly like 2000, 2001. And I think the lesson from '01, if people like want to make analogies, is that so '01, you had to have been like 22, say, to be trading or watching market. Say you were 20 in 2000, just to make the math easy. So that means like nobody under the age of 42 has really seen a normal recession. Like '08 was a crisis and collapse, like V-shaped. They changed all the rules, stimulated, and it exploded higher. 2020 was the same thing, like absolute collapse, massive stimulus, and then V-shaped rebound. But '01 was just like this drudgery of like just going down and down, and the economy was slowing, and stocks went like Nasdaq went from 5,000 to 1,000, but it didn't like go all at once. There was 40% rallies. It took like 3 years. I remember when Google IPO'd in '03. So the low in stocks was October '02. So like things were in theory looking better, but just looked like another fake rally. Like people were like wouldn't touch the Google IPO with a 10-foot pole. It's like, oh, these companies don't make money, it's pie in the sky. And so like to give you an idea of like that was 3 years after the Nasdaq bubble was already bursting. You still had like deep despair and bad sentiment. And I think that could be what we see this time. Like same with crypto and with like tech, big like FANG kind of mega tech, is that you just have like these ongoing waves of disappointment and revulsion and lower earnings, less ad spending, and it just goes on and on. And then in '01, you also had like the bankruptcies, which is again like crypto, like whenever things started looking okay in '01, there'd always be some new fraud or bankruptcy that was revealed. And that's kind of what's happening in crypto. I know we're not talking about crypto exactly, but where every time it looks okay to like get back in the water, there's just like another disaster hits. And that's what it feels like to me, is that kind of thing where you can trade the rallies, like the rallies are meaningful. But I think we're in a real bear market, which is not a V shape. It's more of like a depressing, slow, boring grind to nowhere. And the day everyone gives up, and like anyone that you have ever met that was day trading in 2021 has gone back to like find a regular job like that, because that's what happened in 2000, 2001 as well. Like all the dentists and all these people quit their jobs to day trade. And then around 02, 03, they're like, I guess this isn't going to work out. When we start seeing that, like that could be 2024 or something like that. That's kind of how I feel, is we're going to have this slow kind of depressing bear market that keeps like many rays of hope, but you're not going to get the sort of knee-jerk rate cuts that you used to get that were like the insta stimulus the second things go bad. I think this time there'll actually be pain.
Yeah. Do you think, will there be that light at the end of the tunnel? I guess it's sort of similar to what we saw, as you said, 2003, 2004. Do you think there's lots of talk that we might be going into, I guess, a new secular trend? Do you have any opinion on that, or is that too far out in your
Yeah,
eyes?
I mean, I'm definitely, I think this structural story is still that governments want to spend money and central banks want low rates. And so I think the structural story for something like Bitcoin's still bullish, but like you can't, unless you're just like buying and holding and putting it away and never touching it, which is not what I do. You can't wait for the cyclical, or you can't wait for the structural story. You have to participate in the cyclical story. And the cyclical story is still one more of like tight, not higher rates, but tight monetary policy and like ongoing waves of default and bad economic outcomes. And I don't really see that changing anytime soon. So to me, like what you want if you're long crypto and Bitcoin and stuff is like massive stimulus, right? I think the empirical evidence shows that that's what it does. Is it's a hedge for loose, crazy monetary policy or crazy fiscal policy. And I think that ship has sailed for a little while, because most people acknowledge like, oh, we probably did a little too much in 2020. And so you're going to have to wait for things to get a lot worse before they can get better.
Yeah, definitely. Well, when the government are saying that, what I think it's $1.4 trillion deficit is good, then things got a bit out of hands.
Yeah, it's amazing. Yeah.
Yeah, definitely. So I think you mentioned it before, and I've heard you mention in another interview, like you can sometimes get the direction right, but then your positioning is really what led you down. You might actually not make any money off it. So I guess in your opinion, sort of how are you looking to position yourself for a lot of the things that you mentioned? So I guess you mentioned, bearish on Canada, there's potential for a recession in the US, but there also might not be. So sort of how are you planning on doing that?
Well, so the thing is, I'm talking about macro, but now I got to kind of zoom in. So the way that I actually trade in real life is that I have this sort of like overarching view of macro, and I understand because I talk to a lot of people that trade at hedge funds and that. I understand kind of what the narrative is and what people are trading, but what I actually trade a lot more is the surfing the changes in the narratives as they happen. So like what I'm looking for is, so the EU energy crisis was a perfect example. So you have the like big, crazy, scary story with the UK and the EU, and like everyone's short euros, and that was a really good trend for a long time. And then you start seeing like, oh, EU subsidizing gas prices. Actually, energy prices are like collapsing basically in Europe. Like they went from like 500 to 80, depending on what contract and all that, but yet still euro was on the lows. And what happens a lot of times is the fundamentals are moving, but the narrative stays sticky because of like confirmation bias. And people, once they have a position, just tend to stick with that narrative too long. Like people extrapolate and are like covering their ears when new information comes in if it doesn't confirm their position. And so those kind of inflection points are when I'm really good, because I tend to have a good feel for like, okay, the old narrative is getting kind of stale, but people are like doubling down on it right at the worst possible time. And then so like I'll try to play that turn. And so something like a longer term thesis like Canada, I'll still mostly trade more short term, And so I'll have in my mind, like, okay, these are the things I want to do. Like I want to be long Canadian bonds, long Kiwi CAD like New Zealand against Canada as another example, just because I feel like Canada should have got the halo from the US expansion, and it didn't really. Another reason why like Canada looks bad. Whereas like at some point there's going to be a reopening in China, even if it's not now. And so like even though Australia and New Zealand have a lot of the same housing issues, they may get like the China credit impulse benefit, whereas Canada won't. So like say I like Kiwi CAD higher, generally what I'll do is I'll be long, but then I'll take profit. I'll play reactions against moving averages and things like that. And then I'll also kind of get a sense of like, usually if I'm right about something like that, it'll trend for a while and then it starts to be like just everyone agrees, and then that's usually bad as well. So I try not to be like reflexively contrarian because trends can go on for a long time. So you can't just bail on a trend at the first sign of like, oh, people like this trade, because trend following works in a lot of cases. So generally what I'm doing is that kind of thing where I'll have like core view and I trade around it, or I'll be looking for inflection points, and like it's all about changes, not levels, right? Like that's kind of my whole thought process, is that you understand like the current equilibrium. So you look at all the prices of everything, and those are the sum of all the information roughly in the world, with some distortions because of whatever. And then if you sort of acknowledge that today, I understand this is where we are, these are where the prices, then as new information comes in, hopefully you have a better idea, especially of like what people think reality is versus what reality actually is, to then anticipate that like, okay, people aren't going to be able to stay short euros very long for much longer because just too many things are changing. And then I have all this data that shows like massively short euros position as like everything's looking better. So you can kind of see like the second derivative of the narrative is about to change. Like we reach peak narrative, and then usually like I do a lot of spot, like just delta one positions. And if I have like, usually my time horizon is like 1 day to 1 month. So I like trading events, because if you, and it doesn't just apply to FX, like I do mostly FX, but if you know, like say you're really good at trading like the sporting goods companies and Nike warns, you'll have a really good idea of like, is that a meaningful warning or is it BS? Do they warn all the time and then beat the next earning, like, like to sandbag the earnings? There's a lot of nuance in all the way that like all the information gets disseminated, and then the background. So if you have a really good background in your thing, whatever the thing is, and then new information comes, then you should have an edge in interpreting that information. And then fortunately, like if news comes out, say whatever asset is trading at 27 and bullish news comes out, it doesn't just instantaneously go to 34 and then flatline, right? There's like a lot of price discovery and invisible hand stuff happening in between. So if you have a good confidence in like whether that news is important or not, then you can have an edge in going with it or fading it. So a lot of times there's opportunities to fade news too, especially like in the world where algorithms are trading. Sometimes their algorithms are wrong. So generally my time horizon tends to be on the shorter side. So starting with like this bigger picture and then trying to more like see the pieces and how they fit together and then how they're changing.
I guess, and then you understand how the capital will move the market depending on what event happens.
Yeah, exactly. And if you have a good sense of like important or not, and then what were the starting conditions in terms of like what people thought the world looked like, what it really looks like, and then what positioning is, when you put all those things together, sometimes you can come up with like some pretty decent ideas. And it doesn't always have to be about like a specific binary event. Like a lot of times it's more just like the evolution of a narrative, and the thing gets more and more overbought. And then like with crypto, it was kind of like that. There was like this evolving series of signposts, like the stadium naming and all that kind of stuff. And then finally with the Fed dropped transitory, and then like it was basically over the same day that they dropped transitory. But a lot of times you'll have like a lot of lead ups where you kind of say like, oh, this, things are changing, but no one wants, like people like generally once a trend is going, people just extrapolate it for way too long. But like I said, being contrarian all the time is a bad strategy too. So it's a fine thing, because when I started, I used to always, like when I started trading, I used to just always be contrarian, because if everyone's long and you're short and you make money, you feel so smart. And it's like like it's like an ego thing. Being contrarian is like a big ego thing. But like essentially you can't do one or the other. You have to be able to say like, this trend is early and it's meaningful and I'm going to ride it, or like we're late in the trend, the fundamentals are changing but the narrative hasn't changed yet, I'm going to fade it. And I feel like good traders can do both. And another reason you have to be able to do both is that regimes change. So like there's trending regimes and high vol regimes and low vol. And you ideally, if you want to survive for a long time trading, you have to be able to kind of toggle between the regimes. Like when someone says to me like, oh, I'm a really good breakout trader, but this hasn't been a good market for me, that's kind of like a red flag of like, you're very regime specific, and then you're relying on a certain regime to make money, which is like an external thing that you can't control. Whereas I'd rather that person said like, I'm really good at breakout trading, but the VIX is at 12. So I know breakout trades don't work when vol is this low. So I'm doing a lot more mean reversion. You know what I mean? So like adapting, this is a different, I guess I got to a different topic here, but adapting to the regime, or like some like trading coaches will say like, take what the market will give you, or like do what's working. They're all like cliche truism kind of like bullshit, but they're also true, right? Is that if you have your style and then you want the market to accommodate, you're not going to have a good time. Like I mean, I learned that the hard way, because I had a specific strategy when I was trading equities for myself in 2001, and it worked really, really well. And then it stopped working, and I didn't adapt because, I mean, I didn't know what I was doing. I was 23. And so I kept doing the same thing, thinking like, well, maybe if I just keep doing it, it'll start working again. And it never did. And like people face that in 2021. I know like a lot of people were doing really well on like buying calls through Zoom earnings and things like that. But that was like 2021 was a once in a lifetime regime. You're not going to see that again until the next bubble in 2041 or whatever. So adapting to the regime. And you can also sometimes, like another way of adapting is also modifying your risk, like the size of your risk to volatility. So, in FX, because it's extremely liquid, when volatility is low, you can just double your position size and kind of do what you were doing before. And you're not really at risk of like gap risk and things like that, unless you're trading on a massive hedge fund. So like adapting to the regime and just kind of understanding like what the market is giving you is huge. Like in 08, that was a big thing. Some people just got destroyed because Aussie was moving 500 points a day and they were used to moving 50 points a day. But after you see it move 500 points a day for a week, you kind of go, maybe it's not going to move 50 points a day anymore. Maybe I shouldn't have like, 100 Aussie in it. Maybe I should have 20 Aussie or whatever, 10. So that kind of adaptation, I think, is really important.
Yeah, that's really great insights. Thanks for sharing. So I guess I'm going to go back in terms of like, I guess, trends. Is there any, you mentioned so many today and I think they're very relevant, but are there any that you think aren't getting enough attention that you haven't mentioned?
Like current trends in the market right now?
Yeah, or just future ones that you think.
Well, not really right now, because I feel like we just had a really big trend in everything was so correlated
Yeah.
that I feel like that trend is kind of ending now. Which was like strong dollar, lower bonds, lower stocks, lower crypto. I feel like that has kind of dissipated now. So like in terms of major trends right now, I don't see it. And I'm trading accordingly. I'm trading a lot more mean reversion and just like tactical stuff, try to risk like 0.5% to make 1.5% kind of stuff. Um, I think one big trend in 2023, but I don't think it's time to do it yet. So it's kind of pointless right now, but something to keep in the back of people's minds is I think the yen trade is going to reverse, and it could reverse in a meaningful way. So Kuroda leaves in March, and he's been the architect of the week yen. And I mean, shit, he's succeeded, right? He did exactly what he wanted to do. Whether it was luck or skill, I don't know, but he took dollar yen from 75 to 150, inflation from 0 to 3%. I mean, everything he had set out to do, he's done. So, but people in Japan are getting annoyed with the weak yen because it's creating inflation in a society where, like, talk about, we've never had inflation. Like, we've had 2 or 3% inflation. They've had 0. So I think the psychology of going from 0 inflation to 3 actually might be more painful than going from like 3 to 7, because in Japan, you're just used to prices just always being the same, and now they're not. So I think as Kuroda leaves, I think it'll happen before he leaves because the market will get ahead of it. People will start to look at yen as being kind of cheap against anything. So like whatever, it kind of depends on the macro story, like because crosses against yen behave a lot differently depending on what the global economy is doing. But stuff like dollar yen, sterling yen, and stuff like that, I think could have huge moves lower next year as the yen bounces back from like super overshoot to just more like mean reversion, rational, less crazy levels. And you have a lot of things on your side being long yen right now because up at 150, the MOF's intervening, so that helps you. And then you have like a huge disequilibrium in Japanese rates where like they're holding 10-year rates at 25 basis points, like 0.25%, and 10-year rates are at like whatever they are 4 everywhere else. So that's like kind of, it can last forever because they can print as much as they want, but at some point they won't want to. And then that will help you. And then people just anticipating Kuroda leaving helps you. So I think you have a lot of wind at your back to be long yen in 2023. But like I said, it's still not even December yet. So I don't think it's quite the time, although somewhere around here, somewhere between 140 and 145, I think will be a good spot.
Yeah, it's interesting. I actually just talked to Weston Nakamura from Real Vision, and he's been talking about dollar yen quite a lot. And yeah, I don't think he's as positive. He calls it the widowmaker. I think it's easy, especially with the
So
central bank.
yeah, well, JGBs is the widowmaker. Like people have
Yeah,
been trying that since 1995 or whatever. The thing is, though, the funny thing is now, unless something really, really changes, it doesn't cost you very much if you're wrong because the yields are being artificially suppressed, so they don't go down very much. Like if okay, they might not go up, and you pay like decay and theta on options or whatever, but the yields, it's very hard for yields to go down in Japan because they're being artificially suppressed. But it's true. It's been a bad trade for a long time to try to be short JGBs. But then again, I don't always like, sometimes I feel like that on its own isn't a good reason not to do a trade. Like people were shorting the Chinese yuan starting like last, I don't know, like May 2021, and it totally made sense. Like rate differentials, there's Evergrande in collapsing. There's like all kinds of reasons to be short China, and it didn't work from like May till October. And people were like, that's a shorter time frame, but people were like in September and October when I was trying to sell that to people, they're like, dude, this trade hasn't worked. It's pointless. But sometimes it just doesn't work when you want it to work, and then it really works. So anyways, we'll see. But it'll be an interesting trade to see eventually, can they keep rates? I mean, the counter argument to short JGBs is that they can just pin rates there forever if they want and just transfer all the debt to the central bank. So it's kind of a weird scenario in Japan specifically.
yeah, it could be what we see in all other countries in the future. Only time will
Yeah, I
tell.
wouldn't be surprised because as the debt gets large enough, the cost of servicing just becomes unbearable. And then the only thing you can do is monetize it. And the weird thing is if all the countries monetize at the same time, like in 2021, your currency doesn't really get affected other than it gets affected in terms of like real things like oil and I guess I was about to say crypto, but I guess that's not real. Maybe it's real. I don't know. But in terms of whatever you want to call hard assets, but they've sort of got away with it because all the countries were doing it at once. So that's the thing. Structurally, that's where I think we're going, is sort of like this MMT world where you've just like opened the door so wide that it's impossible to shut it at this point. But there's always going to be these counter cycles that can last years, where the Fed has to regain credibility and they have to hike rates. And, real rates were negative 1.2. Now they're plus one or something. So that's a massive difference in terms if you're holding long duration or like speculative assets.
Yeah, definitely. So, Brent, thank you so much for your time today. We've sort of covered so many different areas. I guess my last question is, what is one message you want people to take away from our conversation?
This is like a completely different thing, but I'll just say, like, since I know a lot of traders watch your show, is everyone loves talking about trade ideas, but the real difference maker in succeeding in trading is risk management and psychology, especially risk management. So, like, talking about trade ideas is the fun part, and talking about risk management is kind of boring, so it doesn't come up as much. And there's not very many, for every 100 how to trade books, there's like one book about risk management, and everyone ignores that one. I would say, like, make your risk management process really good. And then when you have an edge, you'll make money. And when you have less edge, you'll survive till you get your edge back. So yeah, risk management first and everything else second.
I think that's a great way to leave it. So, thanks again. If anyone wanted to find more of your work, or where would they be able to do that?
Sure. So spectramarkets.com that's the website. Spectra with an A. And Alpha Trader is my latest book. It's on Amazon.
Awesome. I'll put that in the description below. So, Brent, thanks again.
All right. Awesome.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.